Hello everyone, my name is James Anadon. I'm a portfolio manager here at Pillar6 Advisors, and I want to welcome you to our second quarter of 2019 Market Outlook. This is our forward-looking economic and investment trend piece that we put together on a quarterly basis, where we take a look at the markets and the economy from where we were, where we are now, and where we believe these economic trends are leading us into the future. Of course, as always, I'll start with a brief synopsis of each one of these points that we will cover here in the presentation. However, if you'd like to stick with us, we will take an in-depth look at each one of these points here in the presentation. First, let's go ahead and take a look back at a summary of market performance. Of course, following the major downside swing that we saw at the end of last year, the market has roared back, posting a gain in the Russell 3000 of 13.88%. And although that sounds wonderful, the Russell 3000 is still posting a loss of 2.18% from the market's all-time high in September of 2018. The short-term positives, or what we call tailwinds, that can propel this market and this economy further are China and U.S. trade tensions seem to be easing. Monetary policy around the globe, including our very own Federal Reserve, is becoming more accommodative to economic fluctuations, and global inflation remains subdued. Of course, when it comes to the long term, there are many negatives or headwinds that we face as a U.S. economy. We are facing a continued slowdown in global growth. There's also a fear of a corporate earnings recession. And although the Federal Reserve's easing measures from a short-term perspective are positive, from a long-term perspective they are not. To put it simply, as we are late in this economic cycle, if the Federal Reserve needs to lower interest rates to flood money into the economy, the fact of them being so close to zero may not be enough to help. The inversion of the yield curve. On March 22nd, the spread of the yield between the 3-month Treasury and the 10-year Treasury went negative, reporting the first inversion since 2007. Although the yield curve has been used as a leading economic indicator for recession, it is important to note that on average, a recession happens 14 months after the first inversion. As we become increasingly more and more of a global economy, it's important to look at all global market conditions to help understand what we can possibly face as a positive moving forward. Currently, we like the value offered by emerging market equities. It is a beneficiary of a Fed rate hike pause and a major beneficiary of China stimulus and a potential thaw in the trade war. The Business Cycle Index is another leading indicator for economic activity. Currently, the Business Cycle Index is letting us know that it does not anticipate a recession in the next 12 months. However, the Business Cycle Index is a very quick moving indicator, so we need to make sure we watch it on a monthly basis. If you remember from last quarter, we put together a slide titled, What We Are Watching in 2019. I want to revisit that because one of the 4 indicators that were on the slide has changed, the inversion of the yield curve. I will cover that a little bit more, and also the other indicators, just to give us a view of where we are still at in 2019 from a visual perspective. In March, we completely reallocated the tilt portion of the core tilt portfolios back into the market, and I want to cover that a little bit more. And finally, we'll end with our current asset class ranking, which coincides with our tilt portfolio changes. That concludes the overview. If you'd like to stick around and go through a little bit more of an in-depth, detailed look at all of these individual sections, please stick around. If you have found the synopsis helpful enough, and you would like to see what we are suggesting you add to your portfolio, please skip ahead to 10 minutes and 47 seconds. Let's go ahead and start with a market performance summary. In Q1 of 2019, the U.S. stock market, represented here as the Russell 3000, had a positive return of 13.88%. International developed markets and emerging markets followed at 10.34 and 9.88% respectively. In Q1 of 2019, the U.S. bond market and the global bond market both gave coupon-like returns. The U.S. stock market, again represented as the Russell 3000, gave us a negative 2.18% return, as well as the international developed markets gave us a negative 2.65% return. However, the emerging markets posted a positive 0.90% return, and the U.S. bond and international markets gave us 4.45 and 4.87% respectively. This is a chart to give us a better perspective on price performance. What we're looking at here is a chart of the S&P 500 given to us on a weekly basis, meaning that each one of these blocks is 1 week of price performance. As you can see, I've also drawn in resistance and support lines and shown you where our strategic cash positions have been, as well as where we just reallocated here from when it broke over the resistance level. Our first strategic cash position came in October when we had a first retest of this resistance level and failed. After the second retest and fail, we sold again. and then continued on the third one into where we were 40% cash right around this range for the tilt portfolios. Again, if you remember in December, we broke this support line and came all the way down to here, and we had no idea if it was going to continue to fall or have a retracement as what we saw coming into this year. In any event, strategic buying opportunities were not presented in here as we were unaware of what could happen next, if we were going to bounce off of the support and this became our new resistance, or if we'd continue and this would be our resistance, which is what we saw for a few weeks. After we broke resistance is when we came in to reallocate from cash to being fully allocated. Although it seems that the US and China trade spat have been going on for a while, there have been reports that a deal is 90% complete. This will improve global trade and business confidence. However, it is possible that the deal has already been priced into this market. Another positive is that the Federal Reserve has stated that they do not see any more rate hikes this year and will slowly taper off the offloading of debt that they have held on their balance sheet. This is mostly because inflation has not picked up and is not expected to in the short term. Just as there is good, there's always some negative, especially in the long term. Considering that this market is very late in the cycle, if the Fed needs to lower interest rates to flood money into the economy, the fact of them being so close to zero may not be enough to help. And that's why the Federal Reserve not raising rates in and of itself may be a negative detriment to the US economy in the long run. Also, as global growth is expected to slow and wages continue to increase, it is reasonable to expect corporate earnings to slow as well. The noteworthiness of an earnings slowdown may not necessarily affect investment decisions through the second quarter, but as earnings slow and wages grow, we may see a push in inflation. Because of these slow raising interest rates, this leaves little room for the Federal Reserve to stimulate the economy or subdue inflation in any reasonable amount of time, and can be a major detriment. Of course, we also have the yield curve inversion. As the yield curve has been in the news a lot lately, I wanted to cover it again. Although I have covered it over the past 12 months, it's more important now than it has been. As mentioned last quarter, we did notice that the 1-year Treasury was yielding more than the 2, 3, and the 5-year. And as well too, we were worried about an inversion. Well, on 3/22/2019, there was an inversion in the yield curve between the 3-month and the 10-year. It's very important to note, however, that another important spread is the 2-year and the 10-year, which still has not inverted. This is a chart depicting the yield spread between the 2-year and the 10-year, and each inversion for the last 7 recessions. The green marks here are inversions which have a recession that follows. The red marks here are inversions that do not have a recession that follows directly after. On average, it takes 14 months to see the signs of a recession. However, as investors, we may have a different outlook on this. What we want to find out is when the top of the market has been. On average, it's 10.6 months, the top of the market from the point the yield curve inverts. However, there's times in history where they've been much shorter than that. We have 2 months for the December 1980 market top, and we have 1 month here for the July 1998 market top. It's also important to note that there's other times in history where they're much longer in between. And there's also one time in history where it was -1 month market top before the yield curve inverted. This chart is a representation of the business cycle index. What we're looking at here is where the business cycle index is today and where it has been in the past. As we see, these gray lines here in the middle are representative of recession, and this blue line is the tracking of the business cycle index. Currently, at a 91, the business cycle index is giving us a 30% chance of a recession in the next 12 months. This is pretty healthy. However, it's also important to note that these movements between these lines here are only between 1 and 2 months long, so it can be a very, very quick moving indicator. From a global market macro perspective, markets are caught between the incoming data pointing to slower global growth and forward-looking factors that suggest improvement later in the year. We think a modest improvement in global cycle conditions is likely through Q2. This would be led by the US Federal Reserve's shift in a more dovish outlook, and China's moves toward policy stimulus. It will also be helped by rebounds from a series of one-off events that have constrained global growth. These include recovery in European automobile production after the collapse caused by the European Union's new emissions regime, a series of natural disasters that affected the output in Japan, and the recovery in U.S. output following the 35-day federal government shutdown in January. Chinese authorities have announced a broad range of tax cuts and it's likely that local government spending on infrastructure projects will be ramped up over the next few months. Briefly, I wanted to revisit what we are watching in 2019. In Q1, we mentioned we will be proceeding with caution if the US and/or inflation increases more rapidly, the 10-year US Treasury rate falls and the yield curve flattens, high-yield credit spreads widen, or the US dollar is too weak or too strong. In January, wage growth year over year was 3.7%, and in March was 3.4%, which leaves us right in the same area. The 10-year US Treasury rate did fall, and the yield curve did flatten, so we'll put 1x through that. High-yield credit spreads widen. High-yield credit spreads have not widened. They've actually become more narrow, so there's another positive. The US dollar is not too weak, and it's not too strong. It's just in the middle, right around 95, sitting at 97.03, slightly higher than where it was in January. It's very important to remember that these are all just indicators, and we are following them. No one single indicator can give us exact days. However, at this point, with the yield curve inverting, that's one indicator off the table, and we are waiting for confirmations from the others. Of course, all of the information that has been covered in this quarterly report means nothing if we don't know how to use it to our advantage. What we're looking at here is a chart called DALI. This is our dynamic asset level investing tool that ranks all asset classes and sub-asset classes as well as sectors against each other in the market. On the left side, you see that there are 6 asset classes. There's domestic equities, which are currently ranked number 1. There's international equities, currently ranked number 2. There's commodities, ranked number 3. Fixed income 4th. Cash 5th. And currencies 6th. The strongest asset classes on this side of the table would be up here at the top, while the weakest are here at the bottom. When it comes to sub-asset classes such as large cap growth, small cap growth, mid cap growth, and so on this row, as well as subsectors, technology, utility, and healthcare, industrials, the weakest assets will be over here on the right, while the strongest assets are over here on the left. It's important to remember that just because an asset resides over here on this side does not necessarily mean that it's not gaining relative strength versus some of its other peers, such as real estate. Real estate used to reside right here in between basic materials and energy. However, recently it's actually gained relative strength versus those two positions, and is currently not too far behind consumer non-cyclical. Because DALI is the #1 driver of the selections for our tactical tilt portfolios, you will notice these asset classes, sub-asset classes, and sectors within your portfolio. We know that all of our clients are not necessarily having us manage all of their money. And so what I want to do here is give you a little bit of perspective, maybe think about adding a few things to your portfolio. Of course, domestic equities are still ranked #1, and that's where most of our money is at. However, international equities still have some value, especially in the emerging market area. Also, it's important to remember that real estate has been gaining some relative strength, and you may want to think about adding some of that too as well. I hope that you've gained some perspective looking at the DALI chart. Now what I want to do is go over how our portfolios are managed and what the asset allocation is currently. Of course, as mentioned, DALI is the main driver of the tilt portion of our portfolios, so it's important to note what we've added. We've added utilities, emerging markets, US large cap, healthcare, and technology. I did mention that real estate was doing well. However, it's also important to note that here in all of the cores of our portfolios, we do have real estate. The tilt section here is where we play most of our tactical role with, our more active management. Next, what I want to show you here is our core portfolios. These portfolios are designed for the 401k investor or the individual investor in mind. This is somebody who wants to go ahead and allocate their portfolios, where a little bit of tweaking may go on here and there. However, for the most part, it's kind of a buy and hold. It's important to also notice here that there are 9 different portfolios, and each one has a different weighting between equity and bond. Here you have 90-10, 90% equities and 10% bonds. However, on the right here, you have a 10% equity and 90% bonds. If you have not reached out to us for a complimentary risk score analysis, I suggest you do so, especially if you decide to use some of these. The risk score analysis can help point you in the right direction of which one of these models is best for you. Well, that concludes our 2019 first quarter look back, as well as our second quarter outlook. My name is James Anadon. I'm a portfolio manager here at Pillar6 Advisors, and I'd urge everybody watching, whether you are a client or you are not a client, and you have questions regarding our tactical tilt portfolios, or even asset management in general and the way we manage money, or perhaps you're interested in financial planning, please feel free to reach out to us. Our information is here on the screen. We are located at 75 Broadway Street. You can feel free to send us an email, check out our website, or hey, why don't you go ahead and give us a call. Thank you very much for listening. We hope to hear from you soon.